If the Federal Reserve decides to cut rates in March, will that cause mortgage rates to drop, and will that cause the housing market to start to pop off again? Will that bring more buyers into the housing market? Now, that's a question that a seller asked me today when I was talking about listing his home, and so I thought I'd answer it here on this channel because some of you might be thinking the same things. Now, in my opinion, I don't think that will happen. I don't think that if the Federal Reserve cuts their Fed funds rate in March, that at that time we'll see the housing market start to pick up. We'll see mortgage rates come down, and it'll be a better time for you to sell. And the reason why I think that is because markets are already pricing in a rate cut. So essentially what's happening, at least in my opinion, is that mortgage rates have come down off their peak, off their 8% peak, in anticipation of this March rate cut. Now, it's less certain now as I'm making this video on January 10th than it will be as we move into the future, right? Things could change. If it looks like this rate cut won't happen as we approach March and it changes from right around 50 to 60%, which is where the probabilities are right now, to around 10 to 20%. If it drops, then we might see mortgage rates start to tick back up come March, and in anticipation for a rate cut in June. Now, if we see the probability start to rise and it looks more and more certain that the Federal Reserve is going to cut their first rate in their March meeting, then we could see mortgage rates come down even further. But it's all going to happen before the meeting. And we'll take a look at some sources. You'll see where I'm getting this data, but I think the economic data that we'll look at leading up to March, the CPI reports, the jobs data, what's going on in the overall economy, will have a bigger impact to mortgage rates than the actual rate cut, because investors are trying to get ahead of the Fed's decision, right? If they think that the Federal Reserve is going to cut rates, they're going to try to lock in mortgage rates at their higher rate now, which is going to drive mortgage rates down before the meeting, and then the Federal Reserve is going to cut their rates, and it's not going to have any effect on mortgage rates. So let's talk about that in this video. My name is Liam O'Reilly, local realtor here in Vermont with Jerry Riley Real Estate. If you have any real estate needs, reach out to me directly. Also, leave me a comment if you want me to make a video about something else. Would love to hear your ideas, and let me know what you think about this one. All right, let's get into it here. So this is what we're talking about with the March rate cut. So last month, moving into the first of the year, there was a very high probability. The markets were pricing in about a 75% chance that the Federal Reserve was going to cut their rates in March. Now it's moved down a little bit. That's what this article is saying. Traders par their bets on March start to Fed rate cuts after strong jobs data. So now they see only about a 50% chance of a rate reduction in March versus 65% before the jobs data. So that's what we're talking about with this Federal Reserve rate cut. And you may hear this in the news. You may hear people talking about it. Oh, the Fed's going to drop rates. That's going to bring mortgage rates down. And then the housing market will pick back up. Then it'll be a better time to list my home, or maybe then it'll be a better time to buy a home because rates will be lower. You have to be careful with that because it's not exactly how it works. And if we take a look at this chart here, we can see what's going on. So this chart is the mortgage rate, the 30-year fixed rate mortgage, and a 5/1 ARM, 5/1 adjustable rate mortgage. And the red line here, so 30-year fixed rate is the blue line. The red line is the Fed funds rate. You can see here, take a look at the blue line. This is the 30-year fixed rate mortgage. You can see that mortgage rates started to tick up even before the Federal Reserve started raising rates, right? It jumped ahead of them by a couple weeks, maybe about a month. And then as rate hikes started to look more and more certain and the Federal Reserve seemed set on hiking their rates, these mortgage rates jumped significantly. Again, way above and faster than the Fed's rates. And then there was a little bit of uncertainty. Is the Fed going to pause? Are they done hiking rates? Then all of a sudden, more economic data came out saying, no, they're not done hiking rates. They're going to keep going. Boom, we see this big hike up. This is the fall of 2022. As the Federal Reserve is still hiking their rates at a fast pace, these mortgage rates are anticipating that, and the rate is rising. Now, as it started to flatten out, we saw a little lull here moving through 2023 before a peak this fall at around 8%, just under 8%. Now, look, the federal funds rate hasn't changed since then. So the Federal Reserve kept their Fed funds rate stable, but at the same time, the economic news that was coming in, the forces of supply and demand where investors are putting their money into mortgages, that's what caused mortgage rates to rise this fall, as opposed to the federal funds hiking their rate, right? They didn't hike their rate this fall. Now, as we see mortgage rates start to decline, that's the markets and these investors, the people buying the mortgage-backed securities, which is what your mortgage rate is based off of. Those people are jumping in and trying to get ahead of the Federal Reserve's rate cut potentially in March. So why will there be a Federal Reserve rate cut, and what should we look out for? Well, the CPI data is coming out tomorrow on January 11th, so maybe it's already out when you're watching this video. That's something to keep in mind, and that's going to have a big effect on what the futures hold, the future market for the Federal Reserve rate cuts have in store. But when we take a look at the overall U.S. economy, we take a look at some of the red flags. I mean, I talk about it all the time on this channel. Consumer debt is at an all-time high. Credit card defaults are on the rise. We have the buy now, pay later programs. They are causing issues. Then there's inflation throughout the economy. People just don't have enough money to pay their bills. And we're seeing the sentiment start to change in the Federal Reserve. We have Fed Chair Bowman here, Michelle Bowman, talk about how the Fed rate policy appears to be sufficiently restrictive, and now she's more open to rate cuts. You know, she is one of the more hawkish Fed governors out there who tends to be less in favor of rate cuts. It has been historically more in favor of keeping rates high, and now she's saying here that it seems like the Fed policy is sufficiently restrictive. So the Federal Reserve governors are starting to come around to more rate cuts. They've been talking about that more in their meetings. And when we take a look at what's going on in the U.S. economy, I mean, we talked about credit card debt, but look at this. 56 million Americans have been in credit card debt for at least a year. We're seeing pockets of trouble, experts say. You know, there's parts of the economy that don't look so great, and that's what the Federal Reserve is taking a look at when they're saying that their policy might be sufficiently restrictive. And so as we get more economic data, as things start to unfold in the economy before the Federal Reserve hikes rates or drops rates, that's when we're going to see moves in the mortgage rate market, right? Once we can understand with relative certainty where the Federal Reserve is going with their Fed funds rate, how that's going to affect the economy, and what the economic data is, then we'll know where mortgage rates are heading. And we'll see that trend before the Federal Reserve cuts rates. Okay? I hope that all makes sense, because this is a little bit of a confusing topic. And we're seeing some pretty strong warning signs throughout the economy. I mean, I talked about that just now with mortgage rates or with credit card debt rising and rising inflation, that there's a lot of red flags in the economy, and it does seem like the Federal Reserve is going to start to drop rates. Okay, the last point that I wanted to make, I was kind of stalling there while I was getting this point, but the Federal Reserve testified in front of Congress in I can't remember if it was in 2019, 2018, 2020, somewhere around then, when they were talking about the 2008 financial crisis. And they testified in front of Congress saying that the financial crisis in 2008 was longer and deeper than it needed to be because of how restrictive they kept their Fed funds rate, and for how long they kept their Fed funds rate restrictive. So they have this in the back of their mind that they don't want to keep their rate too high for too long. Despite what they say, you know, they are worried about inflation and keeping inflation under control. But despite all that, they don't want to cause another great financial crisis. Now, they might end up causing one anyway, but I think they're going to cut rates sooner than they did back in 2008, back in 2007, when we start to see economic trouble shake the economy. They're going to start to cut rates, and they might start cutting rates aggressively to try to avoid a recession. So anyway, let me know what you guys think about all this. Again, look at the leading indicators, not the Federal Reserve's actual rate cut, and see how that affects the housing market. Of course, follow me. I'll be reporting on all this as it develops. Leave me a comment. Let me know what you think, and I'll see you guys in the next video. Thanks for watching.